Hi, everyone. I'm just going to go through really a brief example. It's just three problems, and two of them are actually not that difficult or challenging, I should say. But I just thought I would go through an example because we haven't really covered this same type of problem. So let me share my screen. So for this first problem, we're told Bob uses a perpetual inventory system, data for, and I'm calling it product A1, B2, include the following purchases. We have a May 5th purchase and a July 31st purchase. May 5th, purchase 40 units, cost per unit $5. July 31st, purchase 20 units, cost per unit is $8. On June 10th, we're told Bob sold 10 units. On August 30th, Bob sold 38 units. So first we want to prepare a perpetual inventory schedule for the above transactions using FIFO. We haven't really prepared a schedule before, so I thought I'd go through this with you just so you can see what it looks like. But the first thing we're going to do is record that first purchase, right? So we've got our date of May 5th, our purchase. We purchased 40 items at $5 per unit, which would be 200. We haven't sold anything, so the balance is also 200. Next item, we have a sale, right? June 10th, we sold, they tell us right here, we sold 10 units. So on June 10th, we're going to show what our cost of goods sold is. 10 units times 5 per unit is $50. Because remember, that's the only bundle we have to sell. So that's what we had to sell, 10 of those 40 units. Well, we had 40 units. We're selling 10. We have 30 units left. And those units are 5 per unit. So 30 times 5 gives us 150 balance. And I put a little explanation here. 40 units minus 10 units would give us 30 units. Next, we have a purchase, and our purchase on July 31st. It's right here. We have our purchase, so we're going to have a purchase. We have 20 units purchased at $8 per unit. That would be 160. So now we have 2 bushels of units, right? We have the original, what we have left from that original purchase, 30 units at $5. And now we have this new purchase. We have 20 units at $8. So 30 units times $5 per unit would be 150. 20 units times $8 per unit would be 160. And if we add those two numbers together, of course, it would give us $310. Now we have a sale. And on August 31st, or August 30th, I'm sorry, we are selling 38 units. So again, we have to figure out our cost of goods sold. Okay, so we're doing FIFO. So we have to figure out which units are we selling. FIFO, the first units we purchase are the first units we sell. So that first batch that we still have 30 units of that, right? And we have also, we put it here, but we still have 30 units at 5 per unit. So we're going to sell those. We're selling 30 units at 5 per unit. And that, of course, equals 150. And then we have 8 more units we sold. So those other 8 units actually came from this purchase up here. So 8 units, the cost per unit is $8, would give us 64. So if we add the two together, it's 214. So we know we sold all of this first purchase, right? All 40 units are gone, right? We sold 10 here, we sold 30 here, that's all gone. We sold 8 units of our purchase on, July 31st. So we have 12 units left there. So our ending balance in inventory is 12 units times $8, which is $96. And I did put a little note here to tell you what happened. So again, the balance, for the balance, all of the June 10th have been sold. June 10th purchases have been sold. And for July 31st, we've sold 8 out of those 20 units, which leaves us with 12 units. Okay, now we're going to do the same thing, but under LIFO. Well, initially, everything's the same, right? We still have that May 5th purchase, which was 40 units at $5 per unit, which is 200. Sale on June 10th, where we sold 10 units. We only have 1 batch of inventory, so this is what we sold. So our cost of goods sold is the 10 units times $5, which is 50. Our ending inventory are the 30 units that are left, 40 units minus 10 units is 30 units at 5 per unit. So that's also 150. July 31st purchase is the same, 20 units at $8 per unit, which is 160. So for our balance, we've got our two groupings. We've got that initial purchase. We have 30 of those left. So 30 times 5 is 150. And out of this latest purchase, this 20 units, we have to record that. 20 times 8 is 160. So 150 and 160 together is 310. So if you notice, these first three are the same. Everything here for the first three are going to be exactly the same. Okay. And it will be for your problem also because it's exactly the same. However, on August 30th, that's where we have a difference. Remember, August 30th, we sold 38 units. Well, in LIFO, the last items we purchase are the first items we sell. So we sold all of this, these 20 units at 8 per unit, that's all sold. So 20 times 8 is $160. We also then still sold 18 more items, right? Well, that other 18 items had to come from what was remaining right here, 30 units. So 18 units, and those 30 units were at 5 per unit. So 18 times 5 is 90. So if we add 160 plus 90 together, it gives us 250. Well, what's left? What's really left is out of this first bushel, right? And if you look at it, originally we had 40 units. Then we sold 10 of those, which left us 30 units. Here we sold 18 of those. Well, 30 minus 18 is 12. So we now have 12 units left of that original purchase on May 5th. So 12 units times $5 is 60. That's our balance. So you'll notice this August 30th is different between FIFO and LIFO. Next one is going to be moving average cost. Again, we have that first purchase, 40 times 5 is 200. That's our balance. We have the sale of 10 units. We only have one item or one purchase we could have sold from. So 10 units times 5 is 50, which leaves us a balance. We had 40, we sold 10, we got 30 left. So 30 times 5 is 150. So far, it's the same, right? It's the same under FIFO, same under LIFO, same under moving average for those first two items, okay? We're going to actually get the same ending number from the July 31st, but we're going to do it a little differently. So the first thing we have to do is we have this purchase. We purchased 20 items at $8 per unit, which is 160. And then if you remember, we still have 30 of these units left, right? So here is where I'm calculating it. So we had 150 left, right? The 30 units at 5 per unit is 150. So we're going to take the 150. We have to add on to it this 160 purchase. So our numerator is going to be 150 plus 160, which equals 310. How many items do we have? Well, we have 30 items left from that initial purchase on May 5th and 20 items from our new purchase. So we have 50 items. So 50 units, if we take 310 and divide it by 50, that gives us $6.20 per unit. They've told us to use 3 decimal places. Well, we only need to use 1, but I put the whole 3 out there just so you can follow it for your own. Okay, next thing we have to do, so again, for our actual ending number, we would take 50 units, right? Times, because we have 50 units left, 30 left from the May 5th purchase, 20 from this new July 31st purchase. We have 50 units. 50 units times $6.20 is 310. You see, this is still that ending amount, 310 is the same as it was in LIFO, as it was in FIFO. The 160 from July 31st for purchase is the same. It's 160 as it was with FIFO, as it was with LIFO. This last item, of course, is going to be different. Our cost of goods sold, we're selling 38 items. we're using moving average. So all we have to do is multiply the 38 units we're selling times that $6.20, which means our cost of goods sold is $236. For our ending inventory, well, we know we have, if we had 50 units, which we had, right? We had 50, we're selling 38. 50 minus 38 is 12. 12 units at $6.20 per unit is $74. So this is our balance. This was our cost of goods sold. And that's the one that it was a little different because we haven't really figured it out in quite the same way before. Okay, next one, and this isn't that it's difficult, but we really didn't go through it, so I thought I'd just give you an example. Bob accepted a Visa card and payment for 100 lunch bill. Bank charges a 2% fee. What entry should Bob make? Well, the cash that Bob's going to actually receive is going to be the sales revenue minus the service charge. Service charge expense is 2%. 100 times 2% is $2. So that means the cash is going to be 98. $100 minus $2 is 98. So we're going to debit cash for 98, debit service charge expense for 2, credit sales revenue for 100. For the next one, Bob sold, it's accounts receivable of 100,000. What entry should Bob make, given a service charge of 2% on the amount of receivables sold? So first of all, finding out the service charge expense, it's 100,000 times 2%, which is 2,000. So the actual cash being received is 100,000 minus 2,000, which is 98,000. So we're going to debit cash for 98,000, debit service charge expense for 2,000, credit sales revenue for 100,000. And the last one example I have is Bob Company employees are entitled to 1 day's vacation for each month worked. And May, 100 employees worked the full month. Record the vacation pay liability for May, assuming average daily pay for each employee is 120. So to figure out that vacation benefits expense, it's just the 100 employees times the $120 per day that they make, which is 12,000. So we're going to debit vacation benefits expense, credit vacation benefits payable for 12,000. And that is the only example I have, or the only examples I've created. If anybody's having an issue with anything, please reach out to me. This is going to take you a lot of time. Give yourself a lot of time to complete this. But I know you're going to do a great job. You're going to all do a wonderful job. Again, if you have questions, reach out to me. Have a great week, everyone. Bye.